Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org. Okay, so we've got a problem here where the market is struggling, and what I want to cover off today is it's a difficult market to trade. And one of the reasons it's very difficult is the indexes are going lower and commodities are soaring higher. So depending on the structure of your portfolio, you could be getting killed, or you could be doing really well, or you could be just kind of muddling in the middle. But what we want to talk about today is some of the things that are changing. As Russia is isolated more and more from world trade, we've got some bigger issues coming up there. And I want to cover that off. And then the indexes continue to lose steam, and part of it is financial because we've got some pressures in the financial system, and I'm going to cover those off the European financial chart, and the US financials are starting to break down. Now, commodity trading has been doing very well, and my thoughts on gold, I just want to cover it off a little bit to explain what we're doing. But I think the easiest way to start this all is to work through the newsletter that my clients get every week and just kind of explain what they've been seeing and how things are working. So, and just so you know, on Osprey Strategic, our new website is up and running. And if you're interested, you can get an annual membership for just $8.60. There's also a 1-month trial that you could try for $7. But I think in order to kind of get the real feel of the strength indexes, you'll probably want to, you'll need more time than that. But anyway, that's just an idea. So we offer a weekly newsletter, a weekly video, a monthly recorded conference calls. You get setups every day. Probably the most important thing we cover off in there is the Schnell strength indexes. And I'm going to show you some of those again today, but they have dramatically helped my trading, and hopefully they can help yours. So let's just quickly go and take a look at the newsletter. What I want to show here is, as we go forward, we've been talking about being a bear market. I took this photo on the Radium Highway, and it just had so much symbolism. It was a coming down a hill. You got the bear's about to cross onto our lane, and some people are a little bit surprised at how weak the market is. And I would say bear markets are sudden, except that we've been watching this one form since December. So they're very difficult to trade. The swings back and forth are really big. So first of all, here's the strength indexes. This is my main index, and it's a smoother one. It doesn't get as high or as low as some of the other ones, but the main purpose of it is to help keep track of market momentum. And you can see we've had 2 rallies here, and it got below the 25% level, and it was signaling a rally. So we got another one down in here. And now this is rolling over again. This was on Friday. So my point was this is stalled again, not good. And kind of what we want to see is this thing literally electrified at the upside. And that really shows that the market is rallying, and we haven't had that. And then here are 2 quicker indexes. This first one is what I call the fast index. And these are all just measured a different way. But the idea, when they all kind of get going together, it's a nice place to get on board. And I'll show you that in a second. But anyway, this fast version has stalled. Once again, it didn't make it up into the nice high area where it can kind of keep running for a while. Basically, it got up to a rally area and then just fell down again. So that was on Friday. And then the quick index hasn't even got up to those same prior highs. And what I want to talk about a little bit is the difference between the left side of the chart and the right side of the chart. I'll show you another tool that we use to help gauge that. So anyway, here is the strength indexes. And really, we had 8 buy signals last year. We've had 2 so far this year. And again, we don't know which rallies are going to make it into being big league rallies. We only know that they're starting. And then how the market responds to them is how we can address the problem. But really, if you had 8 buy signals, that's a pretty good place to be watching for the markets to turn higher. So as we get these continued signals, the idea is to be ready. So as an example, all 3 of these were below 25%, and we want to see them start to turn up. They did. And then we want to watch and see what happens. Well, as you can see, they struggled by Friday. All of these were starting to like double top and roll over. just not enough momentum to really get the rally going. So that's an example. Now, if you pile these three together, again, the idea of it is to try and help us find viable lows for the market. And then when they do turn up, we want to try and take advantage of them. Obviously, if you're early in and you can catch some of the big moves up, you're going to make a lot of money. And recently I was asked, I was speaking to a university group, and one of the things I mentioned to them was that we have this problem where as the market starts to rally, we don't know how high it's going to go. And so I like to just stand aside and wait for the market to bottom out and turn back up again. And one of the professors said, well, aren't you afraid of missing the biggest up days in the market? And I just said, well, I'm actually more afraid about participating in the big down days in the market. And I'd rather just stand aside. And normally the big up days, usually with few exceptions, as an example, the November 9th rally based on the vaccinations coming out, that wasn't at a low. It was coming off a low, but it was nice to be part of that. And that big jump up, and then that rally continued on from there. Well, we got really positive data from that, and it gave us that information. But I'm not so worried about missing one big up day. I'm more worried about making sure my capital is protected. And what I find about this indicator is it helps keep me on the right side of the trade, and hopefully you'll find the same. So anyway, we also have a couple of monthly conference calls. This was the title of the conference call this month. And then I did an article for StockCharts back in December, and it was specifically talking about the fact that we were in a very difficult setup for the markets heading into 2022, and why we wanted to be aware of that. So anyway, this is kind of in the newsletter, and you could click on it if you missed it one week. I just kind of leave it in there for a while so people have the chance. Now, remember how I mentioned the left side of the chart and the right side of the chart? Well, this is March 2000, and the market was rolling over, COVID coming down really fast, and as it dropped, then we bottomed out and we started to turn higher, and you could see this progressively improve as we went through. This is May 21st, 2021. We're kind of up in here. And each week we spent a long time up here. The market's relatively strong. But what we did find was on every one of those corrections, the leadership changed. And you might remember the tech theme taking off, and then the SPAC theme taking off, and then the automobile companies really started to take off, like Ford and that type of thing. And then we started to see tech roll over, and then we got into May, and then tech accelerated, and copper and the mining stocks basically paused. And as we went through the market, we saw all these changes. Well, one of the things that we find about the strength index is every time it rolls over, it helps denote that we're changing leadership in the stocks, and so we want to be aware of what's going on. So in this picture here, I've got my long-term momentum indicator, and this tells us how many groups are doing well in the market and have positive momentum. And the issue is most of them are now rolling down to negative, but more importantly, when we get down here, we still have the whole commodity group that is doing well. So until they start to roll over, we're probably not going to zero like we did back in the COVID lows. But the bigger issue that we need to be aware of is as this market starts to cycle back up, we want to be a part of that cycle. And it's helpful if when we do that, when it cycles back up, then we have the confidence to invest because we know the market's actually changing from a downtrend in terms of overall momentum to an uptrend. And you can see the rallies we've had since the beginning of the year have been unable to change this trend. So I think it's a pretty significant chart. I think it helps a lot with understanding, but the difference being when we had the rallies in 2021, we were up in this part of the chart. Now we're down in the bottom here. And so these rallies, if they don't work, they roll over quite quickly because not enough industry groups are participating to kind of push the market higher on average. So these are just some of the charts that I hope will help bring to light kind of the condition of the market. And so, I had dinner with somebody last night and they said, why is the market falling so hard? And they're just friends. And so I just said, well, the market conditions have been weakening for a while. So I'm not all that surprised. And he was surprised, and I was trying to figure that out. Now, the issue, again, if you don't have the data, it's really hard. But for me, this is a pretty obvious graph of how things were changing and how we need to be more participative or more aware of the market backdrop so that we don't get our capital flushed away. Okay, those are some examples. Now I want to roll back over to the actual indexes here and just quickly go through these breadth charts. And yesterday I was just firing through them and I couldn't believe what I was seeing. So this is the Nasdaq advanced decline line going back for the last 5 years, and we're actually sitting way down here on these lows. I should just refresh the chart here. We're sitting way down here on these lows, and the problem we've got is this is 5-year lows in the advanced decline. I think that's pretty significant. That tells you how weak the tech sector is. And then when we go to the high-low data, it continues to roll over right at zero, and it just keeps telling us, no, I haven't got enough strength to kind of get out of the hole. Whereas in 2020, we literally rallied down and we started, within early April, we were already back to making new highs. Well, we haven't done that since November. So it kept telling us to be careful. You can see my notes right on this chart, still means caution. And we needed to be aware of the trend change here from having a very positive backdrop to all of a sudden having a negative backdrop. Hopefully that's not a surprise. I've been trying to communicate that through many different presentations, but this was one chart that I think does a good job of it. So here's the New York advanced decline line, and you can see even this market started to break down. Now it really didn't do it till the end of January, but it continues to get a little worse, and so we need to be aware of these conditions. There is a lot of people that are hopeful that the market is going to turn around quickly. Well, I'm actually fine with it turning around whenever it wants to turn around. That's why the strength indexes will kick in and kind of help me get back on board with a positive direction. So here's the high-low data for the New York Stock Exchange. We've got the same parameter where you can see we can't get back above zero. It just keeps struggling. And so we're sitting down here with a really negative backdrop. Again, this all started in November and really hasn't been able to improve much. And so as long as it's going to have that negative tone to it, we need to be much more cautious with our capital or stay focused on the groups that are working. And if they stop working, then either wait for the overall market to reset or start to recognize what's changing. Anyway, those are just some helpful hints, I think, hopefully to help people understand where we are. So this is the S&P 1500, and you can just clearly see this head and shoulders top structure, and we continue to make this right shoulder. Now, there's nothing saying that we accelerate from here. We could bounce from here and go just as high, but the problem we have is when we're this weak, with as many index groups as I mentioned failing, we're all holding out hope that we're going to start to turn and go higher. We have some new news this week that's making that more difficult, and a lot of the data collection by the Fed or the central banks around the world is starting to make them very aware of the backdrop that they're in, and they need to deal with it. But one of the charts I like to use is my bullish percent index. I'll start with the Nasdaq composite. So the bullish percent index is up here. And only 30% of the charts are on a buy signal. Okay, no big deal. But down here, only 16% of the charts are above their 200-day moving average. These are typical very bearish levels. And, in 08, 09, we stayed down here for 6 months. Some of these are 3-month periods where we hover down here and then we start to turn higher. So maybe we're getting close to that. But because we started in November of breaking down. So the issue is we want to keep watching for these to change. And here we are on the Nasdaq 100, only 28% of the stocks are on a buy signal. And only 21% of the stocks now are above their 200-day moving average. And that's for the large cap tech. That's pretty amazing. When we go on to the New York composite, it's a little stronger, and that's because some of the other names that haven't been as high growth oriented have been holding up a little better. But only 32% of the stocks are above their 200-day moving average. And the bullish percent index, what does this look like? every rally we've had, less and less stocks participate all the way down, and we've continued to have that. So how do we know when it's over? Well, we don't know when it's over, but what we're looking for is for the strength indexes to start to turn and actually show that the rally has enough momentum. Now you can see we have some pretty deep dips here that mark some pretty severe places. We're down here at 32%, and you can see most of the time we drop below this level. We're down here for a while. This isn't a quick trip back to the top. So that's one of the things that I keep in the back of my mind. You know, normally when we get this weak, we need more time. And then eventually what happens is the 200-day moving average comes down, and then you start to see the market turn up. And as the 200 has moved a lot lower, then all of a sudden the stocks are starting to cross above the 200 again and starting to tell us the rallies are back on. Well, that's confirmation for what my strength indexes would help do to help us get back into the rallies. Okay, so for the S&P 500, we're sitting at around 37%. Again, that's very low. And you can see in the last 6 or 7 years, in the last 20 years, there's only been 6 or 7 events where we spend any time down below this level. This is pretty weak. Okay, so hopefully that gives us some explanation of where we're at. Now I want to cover off the financials a little bit because there's a specific segment of the economy that relies on the financials. And if we just quickly roll through the sectors just on a quick short-term view, this is XLY. And again, we're trying to bounce off the lows again today. It's up 2%. And you can see that this long trend line and momentum has been drifting lower since November. Now maybe we can start to turn that up. That would be one clue that we could start to see things improve. Here's XLC, the communications ETF, and that's starting to try and improve as well. XLK, a nice big bounce off the prior low. And you can see all of these have trend lines on momentum that could start to break out, and that would be helpful. XLI trying to turn up, and again, we're very oversold. So if we're going to turn up here, that would be a great place to participate in the rally. Nothing wrong with that. XLB pushing off a prior low, trying to turn higher. So you can see almost every sector is trying to go higher. Here's energy reversing from a very high level. And then XLP, this is still in an uptrend. I'll just say it's working on the bottom side of that uptrend. And then we have XLV having a weak start to the day. And I'm recording this on Tuesday at around noon Eastern. And then here's XLU pushing up to higher highs. So just giving you an overview of kind of everything going on. Now here's XLF, and this was pretty weak to close Monday out. And then on Tuesday, they announced that they were going to try and do a broad European bond to start investing in energy to get rid of the reliance on the Russian segment there. And they would do this overarching European bond to get funding back into the energy area. And maybe that's what's causing these financials to rally, because they were looking pretty desperate. And lastly, we have the real estate, and it's just not doing much. But you can see this morning even there's quite a change in the market tone. And as that change takes place, then perhaps we'll finally start to see my strength indexes rally back up. And again, the ones I showed were from Friday. We're working on a Tuesday. We'd see if they could actually start rallying out of the hole. Okay, so that's an overview. Then I want to get down into the actual charts. There's 3 specific charts I wanted to show, and I'm just hunting for them here on my list. There we go. Okay, so here's the XLF. Actually, maybe I'll just go back like this. Starting with the financials, and then just to kind of make a break here, you can see how we've broken this upsloping trend line going back to March of 2021, and we briefly dipped below, and we're trying to rally out of that hole this morning. That would be good news. And again, we've got a downtrend, momentum indicators right near 0, and we want to see if we can turn it back up again. Broker dealer, same thing. It had broken through support to start the week, and now we want to see if it can hold support again. But the more times we keep testing this level, it's not great. And then we have a downtrend in momentum, and we're right down near 0. Now, if I unwound this chart, a lot of the best places to buy is when your momentum indicator gets back, your weekly momentum indicator gets back near zero and can start to turn up. And that's a relatively nice place to get back on board. Okay, so here's the problem with the European financials. They were $21 for this ETF on, let's say, mid-February. And here we are mid-March, and this thing went all the way down to 15, into the $15 level. So we're talking a good at least 25% drop in a month. And so the real question is Europe going to go into a bigger economic downturn, right? How much of a recession will they have, and will they end up pulling down the rest of the world? We still have the situation from Evergrande in China. And again, that happened a few months ago, but if you'll remember the Bear Stearns and the Lehman Brothers, they were a couple of months apart, and then all of a sudden one took down the other. And when we finally made the decision to have the markets react after Lehman Brothers and the Fed and the Congress came together to try and stabilize things, that kind of marked our low. But it was months apart from the first instance before the second one, and we're sitting there with about the same sort of time frame now on the Evergrande. I think that was early December. So what we want to watch for is if that property problem ends up spilling over into other markets. And of course, Russia's got issues. China has this Evergrande situation. Europe does a lot of lending into the Russian situation and maybe even into the China. So all of a sudden you can see the mess starting to get distorted in the financial world. And what we want to watch for is can we come out of this, right? Are we going to be able to bounce out of here? So with this, we see this big downtrend, and this is starting to turn higher off the lows. We're still, we're up 2% from the lows of yesterday. But the real thing we want to watch for here is can the market stabilize here, or is this just kind of a quick relief rally? And as we realize the situation in Russia either gets better or gets worse, we'll watch and see how the market reacts. And so then lastly, we have the KBE. And the problem we had on the KBE is it's starting to drift under its 200-day moving average or 40-week moving average and stay there. So we pushed lower yesterday, and today we're bouncing back up. And then the real question is, does this hold up here? Do all of these charts kind of get supported at this zero level on the momentum indicator and turn higher? Or is this actually a fail point and we go lower? Lots of people will tell us that war is typically good and the markets can rally during the war. Let's not go on that sort of information. Let's wait until we get confirmation by the actual investors in the market that they're willing to buy these lows and push things higher. It's one thing to kind of get a sudden rally. I think February 24th, we had that low, and literally we bounced off it and went up 8 or 9% on the indexes in a couple of days, and then really did nothing after that. So there was no real follow through. That's what we're watching for, is do we have enough heartbeat here to actually make a big enough rally and get through this? And we don't really want to start to see the financials fail. Okay, so I'm going to leave it there. And again, I think everybody knows commodities have been doing well, but I want to show you something I think is relatively interesting. This is my gold chart that I've been working, and it was literally getting more and more and more lines on it. Inside week, outside bar, inside bar. And it was trying to get going, and you started to see, kept flirting with zero on the momentum indicator and trying to rally, and it was like, oh, is this thing ever going to break out? And then a couple of weeks ago, it started to make new 8-month highs, and then it surged up and actually closed near the lows. The following week doesn't look very good after trying to break out. And then last week it surged up nice and high, and then this week it's adding on to it, so it's pushing up again. But all of this to say, sometimes these charts just they grind you out, and they work you, and they work you, and they work you. And so now this week my chart looks like this, right? Nice, all clean, new 52-week highs, indicator turning up, relative strength indicator turning up, and in general, the whole thing flushing and getting a lot better. So one of the tools we use in technical analysis, right, is to try and start watching for new rallies. and trying to anticipate when they're going to start, or at least be aware. And so the gold one has been one to watch for a while because we've really just gone sideways for a whole year. Anyway, I thought it was interesting just to show you the difference between the two charts. I was getting all worked up about it. Eventually, with all of this inflation, gold's finally got to go. Well, we finally got the breakout, and now the chart looks a lot easier than the work that was in it before. So with that, thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recordings on StockCharts TV YouTube page. Don't be afraid to head over to ospreystrategic.org, see if there's anything there for you. And remember, my blogs on the StockCharts website are at the Canadian Technician. Thanks again for your help. Have a great week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.